So now we will be decoding the wealth blueprint that I talked about, and I will be covering 7 money archetypes. Okay, so these are the 7 money archetypes, and the first one is the brokey. Okay, I've been there. I'm sure you have been there. When we were growing up, we were all broke. We didn't have any money. We didn't have any source of income. We didn't have any assets to our name. So this is where we all start. This is where probably Zuckerberg started. This is where Elon Musk started. We don't have any assets when we are born. We only have our parents. They have assets and they have income. So some of you might be in this stage, and a lot of the billionaires came from this phase. So it's okay if you're at this phase. You don't have to stay here. So that's number one. Number two is the low income employee. This is somebody who's making $10,000 to $50,000 a year. You're starting out in employment. You are in your early 20s, even in your 30s, even in your 40s, and you have a low income around $10,000 to $50,000 a year. My mother was in this bracket, and this is probably one of the worst positions to be in, because this person doesn't have any time and has very little money, and this is strongly tied to the rat race. So this is one of the worst positions to be in. If you are in this positions, you must do everything in your power to restructure this, but we will cover this in depth as well. The third one is the high income employee. This is a senior executive or somebody who possesses a degree, a very valuable degree, law or a doctor degree, or you possess some skill that you can trade with the company, and the companies are willing to pay you between $1,000. This could even be a sales and marketing professional. This could be a public speaker, a consultant. There are many professions that pay this amount. This is a comfortable place to be in. I call them the comfort guys. These guys know how to enjoy their coffee in the morning. They're not in a hurry. They wake up, they enjoy their coffee, and they could smile and laugh a little bit. It's a comfortable place to be, but they're looking for how to go to the next level because they're not there yet. They have achieved a level of comfort. They're also celebrated in their families as successful individuals. They know better that they are not that successful. They need to do some work and they need to really get rich. So these are not wealthy individuals, but they're still considered success. People have kind of left them alone, that these guys will figure out how to make money, and you don't have to bother too much about them. These are the responsible guys. So high income employee. Then you have got the small business owner. So this is someone who has really figured out how to sell to the public. This is the sales and marketing guy. He understands how to market things. He understands how to identify the right products that the market needs and knows how to deliver. This guy has strong leadership skills, sales skills, negotiation skills, marketing skills. And a lot of the internet millionaires come in this category. This is small business owner between $500,000 to $20 million. These individuals tend to be highly charismatic, and they tend to have a good work ethic, decent risk appetite, and a range of skill set. So they're not specialized individuals, but they have a range of skill set, and their core is composed of sales, marketing, negotiation, leadership, public speaking. This is what a small business owner looks like. They're very charismatic, very good at relationships, and that's the small business owner. Then you got the celebrity, the talented, the shining star, the upcoming rising star, kind of like Austin Butler, who played Elvis, or Rami Malek. These guys have just started with a bang. Jack Harlow, these guys have really started with a bang, but there is no certainty of long-term future. They have made money. They have, a lot of people behind them. They have large networks behind them, and they've made some money. Between $1 to $20 million. They made it too quickly. And these guys are financially unsophisticated, a lot of them, because most of their time has gone into developing talent and then marketing that talent. So they haven't had really the time to understand financial statements. They also tend to be very creative, and numbers make them sick. So this is the celebrity archetype. So rich, but vulnerably rich. That's my perspective. Then you got the big business owner. Grant Cardone could be in this category. He was for a long time. $100 to $500 million. My mentor Dan Pena could be in this category. Several $100 million. And I know some people who are in this category. These are the big business owners who own large portfolios of either businesses, real estate, but it's unlikely that the source of their money is one thing. It's never the one thing at this stage. It's a series of things in their portfolio, in their basket of assets. They've got quite a few items. They may be across several industries. If they are in one industry, they are dominant players. So if it's online marketing industry, they are crushing it. They are among the top 0.1%, 0.001%. They're among the top earners. In any industry, if they are only in one industry, they're usually the dominant players. The guy that I met in London who was worth around £500 million, he owned a chain of hotels, and he was a pretty known guy in the UK. He was one of the richest refugees in UK. So if you know someone in this category, and if they're only in one industry, they're typically among the dominant players. And of course, then you have the super rich. I call them the puppet masters, the guys who are playing in billions, tens of billions, hundreds of billions. You have got Mark Zuckerberg in this, Larry Ellison, Elon Musk, George Soros, Trump. This is the super rich category. This is where most of us want to be. So we look at their financial statements. We will understand their source of income and how they make money, each of these. And it's important to analyze the smaller earners also, because if you understand why they are making less money, then you can correct those issues and you can slowly transition to being a small business owner, big business owner, and then super rich. And there is a lot of the people go through this phase. I'm sure Elon Musk at one point was broke. At one point, he may have low income, and then, he'd slowly transitioned out. I know the guy who was worth around £500 million that I met was a low income employee. He was, working small odd jobs, and he was barely getting by. And from that to making £500 million it's a pretty big deal. So don't get disheartened if you see these and it triggers you a little bit, because a lot of the super rich have gone through various phases. And some of you and some of the individuals I'm going to be talking about will be in several of these categories. So they you could have, as I said, if you're in the rich or super rich category, you have to have multiple sources of income. It's never one thing. So before we get into analyzing their financial statements, I wanted to cover some things before that, because if I don't cover them, then the presentation may not make sense. So I wanted to cover the fundamentals of understanding financial statements, because the entire secret of these individuals lie in the financial statements. And how you figure out how somebody makes money really depends on how you interpret the financial statements, because it has many types of interpretations. It's not, everybody's going to give a different opinion of the same company, same financial statement, and everybody's going to have a different opinion. I have sat down with high profile executives who have extremely sophisticated ability to read financial statements, several of them, and they all say different things. The lawyers, when they read financial statements, they look at different things. Accountants look at different things, and the finance guys look at different things. And if you follow somebody like Robert Kiyosaki or Dan Pena, they will look at completely different things. So it's not just understanding the financial statements, but also interpreting it. And so I'm going to be covering some of the fundamentals of the financial statements. This is my perspective, okay? This is not IFRS compliant, International Financial Reporting Standards compliant. This is my subjective view of how a financial statement looks like. This is my opinion, and this is my subjective view, okay? So when I say financial statements, I'm really referring to my interpretation of it. And if you want more information on this, you should consult an accountant, a lawyer. They will tell you what's the technically right thing. There is a technically right thing, and then there is, basically the truth and how we see things, right? So technically right definitions have to be proper, every word for word and all of that. So I'm not going to get into technically right things. I'm going to speak in simple terms, but understand I'm talking about something highly technical and complex, and it has a lot of rules, the financial statements. So, but we're going to be covering in very simple terms and how I see it. And so let's get started. So the overview is the 7 money archetypes. So we covered this. Then understanding the fundamentals of financial statements. Then analyzing the financial statements of 7 archetypes. Then we'll cover understanding their sources of income, structure and strategy of their income, limitations of each strategy and how to overcome them. Then investment philosophies of each archetype. Their decisions are governed by their philosophies. And what is a philosophy? A philosophy is something that determines what's the right course of action. Before somebody decides to purchase something, to invest their money, that decision is governed by their investment philosophy. And one thing about the 7 archetypes that you would find is that all of them have a different investment philosophy. Some are risk averse, some are aggressive, some are shrewd, some, there's different character traits, different philosophies, and they all want to live different kinds of life. That's what governs their relationship. Some value security, some want to have a family, some wants to, leave a legacy in the world. Somebody wants to be known as the richest man in the world. And all of those underlying philosophies govern their investment philosophy and how they, use their money and how they use their time. So we'll cover the investment philosophies of each archetype and the career evolution, which I was talking about. Then section 2 would be understanding the rich archetypes. I've created an entire section where we would be deeply analyzing the rich archetype and how they make money, because It's not simple. It's not straightforward. It's very complex. There are legal layers to it. There are legal and financial complications to it. These people don't have a simple life. These are highly complex individuals. They have got income from various assets in various industries. They are raising capital from banks. They're raising capital from investors. They are have tens of thousands of employees. They use financial instruments. They have various business strategies, their investment philosophy. They have a complex network of people. A lot of the super rich, they hang out around lawyers, accountants, tax experts, lawyers from offshore jurisdictions, bankers. So we'll dig a little bit deeper into their network. Company and portfolio structures. What does that mean? They may have several companies. A lot of these individuals have hundreds of companies, and no joke. They may have 20, 30 businesses, but they may have 100 companies that own those 20 businesses. Or it's a very complex legal structure. We'll cover that, and you'll understand why they do it. They do it to protect themselves legally. They create a maze with offshore entities, trust structures, and a whole bunch of things that, frankly, a lawyer can tell you about it. I met over 40 law firms, and they covered a little bit about how to structure the entity. And you open a company offshore, and then that acquires the onshore entity, and that acquires another company, and then that acquires another company. It's a complex structure. So we'll look at that. Organizational structures. When you have this big of a portfolio, you need a lot of people to manage it from various walks of life, various educational backgrounds, experiential backgrounds. So we look at their organizational structure. This is organizational structure of people, of course, executives who manage their portfolio. And then we'll look at some real life examples, several case studies of super rich individuals and how their portfolios look like, or how I see it. And, understanding their influence and power. These are powerful individuals. It's not that they control money. They control a lot of other things. We'll cover that. And then finally, strategies to transition from the poor archetypes to the rich archetypes from scratch. Because these guys were not born rich, most of them. They started from the bottom. So what did they understand? What did they come to understand that completely shifted their status in society? And what was that paradigm shift that led them to create this wealth in one lifetime, and that most people could dream about? And most of them started from the broke level. So that's going to be interesting. So that's the overview of the next upcoming parts. And now we will cover some of the points from the first section. So we just covered the money archetypes. Now we will be heading towards understanding the fundamentals of financial statements. Let's get started. Okay. So understanding financial statements. There are three components to a financial statement. Okay, if you've never seen a financial statement, that's fine. I remember Dan Pena asked me to send my financial statement, and I didn't have one because I wasn't making any money, and I never had filed taxes. I really didn't understand what a financial statement looks like. And when I saw it for the first time, I felt sick to my stomach. I wanted to puke, because I thought when I saw the financial statement that I would need, a couple of years of training to understand this thing. It looked so complicated. But if you understand a few things, it's not that complicated. And I recommend a book called Financial Intelligence. If you really want to understand all the terms, we are going to be covering the basics, and you will have some understanding of it. But if you really want an in-depth understanding, I recommend reading Financial Intelligence. Okay, so let's cover the basics. There are three components of the financial statement. One is called balance sheet. What's a balance sheet? The balance sheet has mainly two elements. One is called an assets and liabilities. You might have heard about it. And if you sell the assets and pay off all the liabilities, what you will have is the net worth of the individual. So that's the balance sheet. That's all that it has, asset, liabilities, okay? Then you've got income statement, where you've got the revenue, expenses, before tax income, after tax income, gross income, net income. I'm not going to get into too many complications with income statement. So let's keep it income and expense. So money in and money out. And we'll keep it simple. Cash flow statement is the third component. And I'm not going to be covering the cash flow statement in this presentation because it'll make it very complex. So we want to keep it simple because that's what you need right now, and you will understand what you need to understand with the basics. So you've got balance sheet and income statement introduction. I'm oversimplifying this just to make a point. Assets, this is simple. Assets put money in your pocket, and liabilities take money out of your pocket. Okay? Next time you go on a date and you look at a girl who's expecting you to pay the bill, you'll have to look at her and ascertain, is she an asset or a liability? And I'll let you answer that question. So that was a joke. The asset puts money in your pocket, liabilities put money out of your pocket. Okay. Now, if you take that girlfriend, she's super hot, and then you take her to a office party, and your boss looks at her and decides to promote you, then she would be an asset because she's enhancing your image. So it's really a question of point of view. But assets put money in your pocket, liabilities put money out of your pocket. That's the fundamental definition. Then income is money in and expense is money out. I've really made it simple. Okay, now that's not the technical definition, obviously, of income and expense, but it fundamentally means money in and money out. There is very complex technical definition, but let's just understand this. So here is how the balance sheet and income statement are linked. If you notice here, assets produce income, okay, and liabilities create expenses. So one puts money in your pocket, another one puts money out of your pocket. Start identifying people in your life who are putting money and time out of your pocket, and don't add to the income statement, okay? So this is how both of them are linked. Assets and liabilities are linked to income and expenses. Assets create income, liabilities create expenses. Types of assets. Why am I covering types of assets? Why am I going into all of this detail? Because if you understand types of assets, these are class of assets that most accountants will not put in the asset column, but I am putting in the asset column because that's what they are, assets. They can generate income. Technically and legally, the accountants and lawyers would disagree, but essentially, if something puts money in your pocket, that's an asset. You cannot book it in your audited financial statement as an asset. You need an approval of an accountant, but this is for our understanding, because assets are of many, many kind. So we'll cover that. And if you really understand the assets that you have naturally and how you can use them, and I'll also, use these to explain how billionaires make money and made money, you will really understand that those things were really asset. For example, I've written down the mind, the brain is an asset. Elon Musk, in one of the talks, he said that what separates us from animals, what's our biggest strength is our mind. We are not physically stronger than them, but We have a mind that's extremely powerful. And mind wasn't considered an asset. I don't think you can book a mind as an asset in your audited financial statement. But if you look at what's happening in the world of AI, intelligence, that's a huge asset in today's world. There was a time where it wasn't considered an asset. I mean, legally, it wasn't considered an asset, and legally and technically. But in today's day and age, I mean, you look at NVIDIA, it's blowing up. So obviously, they're creating AI technology, and that is a huge asset. I would argue that that's the biggest asset in the world is your mind. So assets are of two types. You've got tangible and intangible assets. Okay, tangible are physical that you can touch, and intangible are the ones that you cannot touch, but they exist because they produce money. So intangible assets, our fundamental asset is time. You don't want to waste time. Time is an asset. Your brain, as I mentioned, is an asset. The things that we can do, human beings, with our brain is incredible. Most of the billionaires, actually, if you look at Zuckerberg, he didn't have anything else. I mean, he had time, he had a brain, and with that, he started to mint money, and then he's a multi-billionaire now. So brain is your asset. It's intangible. So knowledge and skills, degrees and talents and network, all of these are assets. You could use knowledge and skills to make money. You could use your degree, leverage it with a company, make money. Talent, you can make money. Your network. They say your network is your net worth. I've analyzed, several companies, multi-million-dollar companies. And when we are looking at the value of the company, one of the first things we ask is, what's your customer base? How big is your customer base? And one of the most valuable resource of a company is its network, base of customers, right? That's the network. And if you look at internet companies, one of the most valuable assets is their email list. Even right now, I could argue that one of the most valuable assets you have is your contact list. I mean, you take away your contact list, and what are you going to do, right? Network is important, and that's why these companies have become so valuable. Facebook, LinkedIn, Twitter, all of these are large network. So who has got the biggest network right now? Some people might say it's The Rock. Some people might say it's Mr. Beast. Some people might say it's Kim Kardashian. But the biggest network is owned by Mark Zuckerberg. He owns Facebook, and most of the world is over there. I'm not talking about followers. He literally controls the network. Even if people don't follow him, he still controls all the network. And also now Elon Musk, who owns Twitter, which is also a very large network. So we'll cover that, and that's an intangible asset. Most people don't consider this an asset, but it's an asset. A lot of the accountants are not going to let you put your network, in your audited financial statement, but it's an asset. As I mentioned, a lot of the things that I'm saying, the accountants and lawyers will say technically it's wrong, but it's true. If you just look at it, if you just look at the world, it's true. Network is the biggest asset. There is a reason why Elon Musk is one of the richest men in the world, and Mark Zuckerberg. They are connected to huge networks. Joe Rogan is another example where he has a big network, not as big as Elon and Zuck, but they still have. If you look at the transition of Elon from 20 billion to a couple of 100 billion, what changed was he was getting access to new networks through influencers. More and more people knew about him, and his network blew up. So network is extremely important. Tangible assets are cash in the bank, your savings, cash flow producing real estate, cash flow producing businesses, stocks, currencies. These are more tangible. You're familiar with this. And then you've got intangible, liabilities are also tangible and intangible. So let's cover the tangible liabilities first. So if you have a house and you live in it, you own it, some people say that's an asset. Remember, definition of a liability is takes money out of your pocket. So if you're living in it, you are still spending money on the house maintenance, and that's a liability. Now, some people say house is an appreciating asset. Definition of asset is puts money in your pocket. So how is it an appreciating asset? It's an appreciating liability. Yes, it's going up in value, but it's also taking money out of your pocket. Okay, so if you live in the house, it's a liability. If you rent the house out, it could be an asset, depending on how much the cash flow is, because it has to cover all the expense and still put money in your pocket. So it has to qualify as an asset. So it depends. House depends. If you live in it, it's not an asset. If you rent it out, it's an asset. Unused car, which doesn't produce income. So if you have 2 or 3 cars, you don't use 2 of them, and it's just lying down. It's getting rusty. You're spending time and money to manage it, maintain it. It's not producing any income, and also it has got trapped cash. You could sell them and get the cash, but they're going down in value. They're taking time from you and attention, and it's not producing anything. That's a liability. Then car loans, house loans, student loans, they take money out of your pocket. So that's tangible liabilities. Intangible liabilities, this is my favorite. Bad network of friends who distract you, who load your brain up with cocaine or, some drug, or, don't let you work, affect your self-esteem, affect your mind. All of that is taking away your time, destroying one of your fundamental assets that you could actually use to make money. They destroy it. Time is being destroyed. Time is one of the most valuable assets. We don't have a lot of it, and it's going by. So bad network of friends can destroy your time, and time could have been used to make money. So, and you're spending money while you're hanging out with friends. It's a clear liability. So that's one of the things that Dan Pena in the seminar makes us do, is remove the friends who are not an asset to you or not valuable to you. They're not related to your goals. Remove them. Bad network of friends. Toxic relationships. If you have a woman in your house that calls you worthless, doesn't treat you right, your self-esteem is getting affected. People in your life who doubt you, and because of those doubts, you don't start projects, you don't use your skills, you don't use your knowledge, you don't express yourself, you don't communicate. All of that has become a liability now, because all of these things affect how you use your skills, whether you trust your skills and knowledge or not. You may have knowledge, you may have skills, but they're unused. When you have an asset and you don't use it, it's not really an asset. Asset is supposed to be leveraged to make money. How many skills do you have that you haven't used yet? All of that's trapped value. Trapped value. You have something valuable, but you don't share it with the world. You don't go on the stage. You don't open your mouth. So, people don't know you have it, and, it becomes a liability. So, bad and incorrect information, this is one of my favorites. All the stuff we heard in school, absolute garbage, right? A lot of the stuff was not true. We believe it, and we operate on it. We hear, invest in the stock market, buy this crypto. All of that's liability. You're not good enough. All of that's incorrect information. Ignorance or lack of understanding. If you don't understand financial terms, if you don't understand sales, marketing, negotiation, public speaking, that's ignorance, lack of understanding. Slappy happy, as Dan Pena calls it. All of these are liabilities which are intangible. Again, accountants wouldn't agree to put in liabilities ignorance, but it's a liability. If you're stupid, you will get taken advantage of. A lot of people who gamble their money, that's out of ignorance. They don't understand the game. Bad habits that cost money and time. This is straightforward. Okay, so tangible liabilities I've covered. This is an important note. An asset can become a liability, and a liability can become an asset, depending on who is in charge. I'll give you an example. So I was 16 or 17 years old. I had bad habits. Every time I would get money, I would buy cigarettes, alcohol, and substances to get high on. Now, money is an asset. I put it in the asset column, but at that time, almost a decade ago, I would have used money to destroy myself. So it would have been better for me not to have money. It would have been better for me not to have time, because who is in charge matters. So, and now when I have money and time, I use it to make more money. I use it to do good things. So again, that comes back to the brain and comes back to the network. So it depends who has the money. It depends who has the time and what do they do with it. Somebody could have a couple of $1 million, but they may blow it up on women, drugs, and a whole bunch of other things, and you may lose it. So it's really about who's in charge and who's in control. You heard or hear about celebrities who got $10 million and destroyed themselves, and you think, oh shit, if I had $10 million, what would I have done with it? I would have made hundreds and hundreds of millions. I would have educated myself, get mentors, do so many things with it. This guy just blew it off. So asset can become a liability, and a liability can become an asset. So example would be a house. If you renovate it, put it on Airbnb, that was a liability, but now it's become an asset. So that's for today, and I will see you in the next video very soon, where I'll be covering the rest of the agenda from section 1 and section 2, and I'll see you in the next part.